Welcome to Trillions. I'm Joel Weber.
And I am Eric Balchunas.
Eric, almost 2025 here.
Yeah, I know. I get to write my outlook. We got reviews coming up.
Oh, those were due already. All of that was due already. The good news here.
No, dude, not the numbers, not the written part.
Yeah.
The number, that's the important stuff, though.
The good thing is we're going to have some help today about how to think about what's going to be coming at us next year.
Yeah, so even though I have an outlook, our outlooks, we can't really talk about like tickers that much. We can't give investment advice, but there are people who look at ETFs, buy ETFs. We're calling them ETF strategists.
Yeah. What do?
They are, again, we had a sideshow called ETF Master Chefs. To me, they are chefs that make portfolios of using ETF ingredients. So they are, in my opinion, the best shoppers of ETFs out there. So when they have a list, it's usually not the most obvious ETFs. In maybe another metaphor that I like to use for these, and what we're going to talk about today is, remember the video stores in the 90s and 80s when you'd go and there'd be like a wall saying employee picks?
Yeah, and they'd have those little like coin things that you would like take off the hook and take it to the counter.
And a lot of the movies were not obvious, right? That's where you'd find like some foreign movie or something from the 70s that was gritty. And I learned to really trust the employee picks, and they're the people who were at the counter and would love to have a conversation about movies. This is old school video stores. That is what ETF strategists are to me for ETFs. They are nerds at the highest level, and when they have ETFs, not only is it interesting to pick out like what ETF did you pick, but why'd you pick it? Because they have they have to put a portfolio together, so they have to like work the macro theme in too. So it's kind of a two-for interview when you talk to them.
So joining us on this episode, John Davi of Astoria Portfolio Advisors. This time on Trillions, Astoria's 10 ETFs for 2025. John, welcome back to Trillions.
Great to be here. You've
been on Trillions before. You've been on the Master Chef episodes that Eric referred to. I was kind of taken aback by how good of performance 2024 was when you did your 10 picks. So you just copy and paste, right? 2024 into 2025 and repeat?
Little different. Last year we were pretty bulled up. We thought the Fed was going to cut. We had an earnings recovery here in the U.S. And, the average stock valuations was not that expensive. So we thought it was kind of made a lot of sense to own a lot of equity picks last year. And
how good were your picks last year?
So last year's, and I would just caution people to say, we've got GIPS compliant SMAs, fact sheets on our websites. We have ETFs that you could look at our Morningstar rankings. But inevitably, people always ask me, how did last year's, list do? So
yeah, I was just going to get it out of the way by doing it first.
Equal-weighted basket was up 21% last year. We have global macro ideas. There's international, there's fixed income, there's alternatives. So, the equal-weighted S&P was up 26%. Since our publication, our equal-weighted basket was up 21%. I was pretty happy with it. 100% of the ideas were in the money, let's say. Usually about 70-80% of the ideas are like positive returns. So I think it was, in retrospect, this year I think was a fairly easy call, but very different for next year.
So nothing from last year's list can be on this year's list.
Eric, you know this, but if I put SPY, IMG, GLD in the list every year, no one's going to read it, right? So The idea is to give kind of unique, actionable investment ideas. So I do like to kind of change it up. There could be a theme like small caps, which is repeated, but we would want to change the ticker, let's say.
Let's talk about that. Top of the list is small caps. Somebody, I can't remember where I read it, maybe it was you, said that small caps are potentially the opportunity of a lifetime right now. Unlike international, they've got, potential. You have two small cap ETFs on here. I'll read them off. Joel, you tell me if you've heard of either of these. Wisdom Tree U.S. Small Cap Quality Dividend Growth Fund and the Alps O-Shares U.S. Small Cap Quality Dividend ETF.
Those tickers are DGRS and OUSM 0
Yeah, so let's first talk small caps. I feel like small caps we've seen this movie before. It's always supposed to be the year of small caps. They have a nice little month or two, and then bam, large cap Q type stocks take over. And I've seen it happen over and over and over. Like that Marshawn Lynch video. You just got to run through a guy's face over and over, and that was his key to like being a good running back. The Qs to me is Marshawn Lynch, and the defender is the small caps. They just can't ever get going, let alone a regime change. You think this is the year?
I think so. I mean, I think as a prudent investor that is trying to buy low and sell high, Qs are pretty expensive, right? Now, they did that big rebalance last year where they modified the weights and, they lowered some of the Mag 7 exposure. So it's not as egregious, let's say, as let's say in the S&P 500. But, I mean, we had an epic rally, right? The last 2 years in the S&P, it's up almost 6% between last year and this year. So it's just hard for me with a straight face to talk to an advisor and say, look, we're going to just be overweight U.S. large cap. I just think you've got to play that margin of safety, and small caps, they're cheaper. And the products that we use, there's some underlying alpha signals. But, no doubt the call is that, like, we're going to have like a positive economic backdrop. You've got like the red sweep. There is like a Trump put is what we're saying. So, like, do you still want to be overweight, Qs and SPYs, or do you want to like take a little bit off and put it into like small caps? And we would say use some small caps.
And why these two?
Well, I mean, so, last year, let's say we would have used the S&P 600, the SPSM, which is just like the benchmark. But, in small caps, there is some underlying alpha signals that you can gather. And I think these two products, not only have they performed better than, let's say, like the small cap index, but it's really kind of what we would do. Like, we run SMAs, and like, so the OUSM, has 100 stocks, let's say, right? Which is kind of what we would do. And we've got a couple of ETFs, which we have like very concentrated portfolios. So I think that, if you look at, let's say, the median multiple for small caps, they trade in the 35th percentile. Large caps are in the top percentile. And here's one stat, and I don't want to get too wonky with stats, but like, the main point that we've been arguing is that there are other growth opportunities besides the Mag 7, right? So if you just look at the S&P 500 and 400, there's 240 stocks that have had earnings growth of more than 25% over the last 12 months. That's a lot of stocks. There's 41 that have grown their earnings faster than NVIDIA, 59 that have grown their earnings faster than Amazon, 92 grown faster than Meta, and 170 faster than Google. So, you can stay long Qs or, the Mag 7 ETF, but, I look at like sentiment, it is so stretched, right? That Mag 7 ETF from Roundhill's gained like $1 billion in the last year. I mean, tremendous job, but I'm like, there's so many late cycle indicators I see out there. And, at the end of the day, we're supposed to be buying low and selling high, right? That's what advisors want us to do. So that's the kind of rationale for small caps.
What you're talking about, this idea that, okay, the Mag 7, it can't go any further, the valuations, I feel like it points to this like possible existential crisis, like someone like yourself who's very educated. You've had mentors. You've seen markets before. It just seems like this market sometimes goes against everything that people have been taught. And because I agree with you, it all makes sense. Like they're due, right? That's like they're due to like have a bad year. But they were due like 100% ago. Like that's the problem. They're always due. And they just keep, like I said, Marshawn lynching everybody.
Yeah. Well, the analogy I would say is that like we have these conversations with advisors like, okay, so first of all, we're not saying to sell all your SPYs and your Qs. We're saying like take a portion of it, take a third of it, right? So here's the options that we go through with advisors. Okay, do you want to buy value? And they're like, all right, value works like one or twice every 10 years, right? So like we're not gonna like play that game. International, right? You have your Europe versus US tweet that's been going viral. I mean, that's just like nobody wants to buy international, right? So sell your SPYs and Qs to buy something that rarely ever works. So that's out of the option. Then we get into this conversation of equal weight, which they're more receptive to, right? So RSP is taking in like 13 billion inflows year to date, and it's up to like 65 billion. So it is like a big reputable product. We think there's flaws with like, equal weight indices. Small caps is something that like, I think is more realistic that people would tilt to. So they're like, all right, we'll give that a shot. Like we're not going to buy value. We're not going to buy international, So we're just trying to like tell people like, look, let's look for a margin of safety. But you're right, Eric, to the point that it's like a local automotive that just keeps powering through. But, the economic history would say like if you've got a supportive backdrop for risk and you've got this, Trump put and a pro-red sweep, that would bode better for small caps.
Okay, John, I'm going to keep going down the list, but I got to ask you, there were 2 ETFs for small cap there, and there's 10 overall. Can you count?
Here's the backdrop with that is that so the history of this report was that I was on the sell side as like a content, ETF content producer, and I did want to go to the buy side. I wanted to join. So I'd go on these interviews and be like, I want to, manage money. And they would be like, well, you've got no track record. You can't get a job here. So I had to put together a report to kind of get a track record. And then I started doing that and had good performance. And they're like, well, you actually don't like track, any kind of real money. Long story short, the list used to have just 10, but over the last few years, as we are like so far deep in this economic recovery, S&P has been on this bull market for 13 years. We added some other tickers, for that theme, but it's usually like 10 themes.
Yeah, 14 tickers. Yeah. Okay. All right. Just checking. Okay. Yeah. So what's your next theme?
Well, I mean, to Eric's point, I do think that the Mag 7 is, a theme that you should tilt away from. And we firmly believe that. We run SMAs, quantitative stock SMAs. We've been doing it for, the last 7 years at Astoria. We've always equally weighted. Back in Merrill Lynch research in the late 90s, early 2000s, when we put together like these quant baskets, we used to always equal weight. So, about a year ago, so we launched ROE, which is an equally weighted quality ETF, and because we were worried about the Mag 7. So that fund launched in August 1st of 2023, and it takes, 4 or 5 months to launch it. So we were thinking about equal weight like very, very far, a long time ago. So the problem that we find when you use the equal weight Russell 1 index or the S&P 500 equal weight index, you get this like concentration in like small value, and your tech exposure goes from, let's say, 30% SPY to like 15%. And, one thing I'll agree with Eric is that like I don't ever want to be on the way tech. I think tech is just like a power train locomotive. You want to stay long it. So if you sell your SPY to buy, RSP or there's Russell 1000 equal weight ETFs. You're going from like large growth, large blend to small value, and not just not something that we wanted to do. So for ROE, what we wanted to do is basically take the S&P sector weights and kind of match it. So we've had good performance. We've beaten the S&P equal weight index by like 650 basis points since we launched. And it's 100 stocks equally weighted, so each stock is 1% weight, whereas in the S&P 500 equal weight index, each stock is 20 bips. So, you're really not going to get like that marginal contribution to return if, like, let's say NVIDIA goes up 200% a year. So that's something that's kind of near and dear to our heart.
Let me talk about this one here. This is one of my most underrated ETFs, which is the First Trust U.S. Equity Opportunities ETF. It used to be called the IPO ETF. It is an IPO ETF. It's IPOs and spinoffs. Why that? That is an interesting pick. I like it.
Okay, so one thing we wrote about in our report is that, we have to go into far corners of the market to try and find, attractive, returns, let's say, just because we think, the S&P and the Qs are kind of expensive and crowded. So something like FPX is kind of idiosyncratic. Like, yes, like the regulatory backdrop is improving, but whether the Fed cuts, or raises, I don't know if it's going to necessarily drive the IPO spinoff, kind of market. So, I've been following this thing for a while. I think the underlying provider, Yosef, I can't pronounce his last name, but he's been in this space. He's like the one guy that does this index, and like he's been doing it for like as long as I've been working, actually, which is like over 20 years. So the last year, it's actually had good returns. It's up like 47% over the last 1 year. SPY is up 34%. It's got almost $1 billion. There's 100 stocks. They cap, the stocks, 10% on the upside. So, but it is like, the largest 100 most liquid companies that have either gone public, whether they're an IPO or spinoff. And then there's also some acquirers of recent IPOs that are included in it. So
does it really only work though if there's a lot of IPOs?
Good point. I mean, I wouldn't say the IPO calendar was as robust last year as what we think will be in the next, like the one thing about like, Trump's presidency, I would say is that, I think if you look at like who he's picking in his cabinet, I think they're going to deregulate the heck out of the financial industry, which I think is a good thing. And just the people I know that work at banks, they're like, there's no Christmas, there's no Thanksgiving, we're doing deals or IPOing, like M&A, like nobody's taking a holiday. So I think that, the next few years is going to be a very different market for IPOs and M&A.
It's interesting. David Cohn, who has this podcast called Inside Active, he was interviewing the guy from, I can't remember the asset manager, but it was a mutual fund manager. He interviews active managers. And he was saying the same thing, that M&A he was really into and he liked the small caps for that. It's interesting. I bet we'll hear more about that. You said everything I would say about it. The only thing is the FPX, Joel, to me is like catch and release. You take in these IPOs right when they hit the market. I think it's like within a month. And then you release them. I think it's up to 4 years.
4 years, yeah.
So the problem is a lot of these big indexes like SPY and even the Russell, they're pretty conservative. A stock has to jump through a bunch of hoops before it can even make it in there. So like if you think about investing in the equity markets, and a lot of IPOs go public when they're large, you kind of miss them in that sort of toddler phase before they become teenagers and in the index. And then when they get the index, they got a small weighting. So this ETF, Joel, I went back one year and looked. It's beating the S&P since it came out. And the reason is there's so many dogs, a lot of dog IPOs, but there's a couple blockbusters, Facebook, now Meta, Tesla, and this thing had it when it was doing the hockey stick. So you only need a couple grand slam home runs to totally offset the dogs. And I just like it because it's like a portfolio completion. You aren't getting a lot of these stocks in your broad-based indexes. So that'd be my case for FPX.
Yeah, and 25 years ago when I first started working, like Russell would only add IPOs at the end of the year, at the June rebalance. Then they changed it to like, I think monthly or quarterly. So you agree. And I don't think it's as like hot sauce-ish. Like I think like you can kind of like keep this.
Mild.
Yeah, mild. Yeah, exactly.
It's like the blue cheese they give with the wings. I mean, it's not like your main course.
Right.
But it's not. Yeah, no, this is going to be moderate.
Blue cheese, does make wings taste better. That's for sure. Okay, so this
especially after the hot sauce, right, Joel?
This is where
just kidding.
This is where you bring in a little bit of crypto, and I think this is interesting because we've talked about this before. Bitcoin ran away with the year.
We've talked about Bitcoin on this. Listen, this was the year of Bitcoin.
It was the year of Bitcoin.
Yeah.
We've talked a little bit about Ethereum.
A little.
And how you've been kind of anti, Eric.
Well, I've just said Ethereum ETFs coming out after Bitcoin ETFs is like the headliner coming on after the main band. Like it'd be like Sister Hazel coming on after Nirvana.
Yeah,
like who in the hell would stay for that, right? And I was right. These things have not taken in that much money. I think they'll succeed over time, but Bitcoin is the main event. And it felt a little like a...
But get this.
Meh.
John Davi says 2025 is the year of Ethereum.
That's why, that's interesting. I like it.
Okay,
well,
ETHW.
The Ether people are going to love this. They're looking for anything.
I mean, Bitcoin, first of all, it was like a lot of front running for, before these ETFs launched. And, I know you've covered this extensively, Eric. But, I mean, it's hard with a straight face to buy an asset that's been up so much in the last year. Right. And like, there's levels I think you should think about, like, Bitcoin at 100,000, kind of stalled. But, Ethereum is, down. It's like down 35% from its all-time highs. I personally would rather buy a basket. Like I'm interested in the BITW, like the Bitwise OTC product. That's like the kind of the index approach, just because I think it's a little bit safer. But that is OTC, and it is 10 ETFs for 2025. When it's going to move to the NYSE pretty soon, but Ethereum I think is just something that's cheap. Look, I don't think crypto is an asset to ignore. These big institutions putting their names behind it. BlackRock, Fidelity, and these firms, like they go out and they meet with like central banks, presidents of countries. So I think you want to own crypto, but I think you have to be tactical. And you have to wait for a better entry point for Bitcoin.
And that looks like Ethereum. I just want to call out, though, your logic there sounds a lot like the Mag 7 logic, which is this thing number go up, and John Davi says maybe don't keep going up.
Were you trained as a value investor? Like, did you mentor under a value person?
Well, in 99 when I started, like momentum was not a big factor. It was not like, it wasn't.
So wait, you started in 99, so you saw the internet bubble burst like 2 years into your job, and you're okay, well, I get it. That probably shaped your whole worldview since then.
Absolutely. Yeah. I mean, I think depending on when anyone enters the industry, they're going to have like these preconceived, biases for sure.
But will the Fed it's part of the issue is, will the Fed let that happen again?
So I don't know, but like the Fed at like, the Fed funds is like 4.75, 4.5. So, I mean, the one thing about Trump, and, I'm not a big political guy. I have to be moderate by general because I have clients on both sides of the aisle. I would say, he's been a fixture in New York City and New Jersey for a while. And, I'm from Queens. He's from Queens. Like, he is do whatever it takes, right? So I think that he will keep the economy floating. I do think that he keeps crypto floating too, because he's kind of pretty out loud with it. I just wouldn't buy Bitcoin up, whatever it is year to date, 100, 200%.
Yeah, it's up a lot. Yeah, it makes sense. We'll see if you're right, I guess. Let's talk a little bit about the mortgage ETFs, DMBS, Double Line Mortgage ETF, and Spider Portfolio Backed Bond ETF, SPMB. Remember when I pitched it. It was a Muni show. I pitched to him, and he started falling asleep. Mortgages a little more interesting.
Yeah, my pulse is still pretty low.
Yeah, make this interesting for us.
Well, I would say that like 2-3 years ago, we had a lot of bond ETFs in the list. We didn't have as much equities because that was kind of like our outlook. I would still rather own equities, next year than I would bonds in general. Most credit spreads are very, very tight, whether it's, traditional, high quality corporate, high yield spreads. Mortgage-backed securities, they're not as tight. So there is some, kind of intrinsic value there. So that's really the story. We don't have to go deep into it. But I don't love fixed income in general with, higher inflation. And I think, the average stock, equal weight, value, KBWB, KRE, there's much more upside relative than on, corporate credit or high yield bonds.
Okay. Alternative equity. You've got merger arbitrage, ARB, great ticker. What are you seeing in that space that makes you want to get in there?
So, and like we don't own ARB, we don't own FPX. The idea, again, for this report is like get the thought out there that you've got to look somewhere else besides U.S. large cap equities to find attractive risk returns. But yes, it is part of like the whole deregulation theme. It's low standard deviation. The RRB ETF has got like a 3 standard deviation. If you look at like, let's say ACWI, it's like 15%. So its max drawdown, since inception is like 3%. So it's a low vol strategy, and it's meant to play the kind of, M&A theme, let's say. So,
it's interesting. So let's go over M&A. This is merger arb, right? So you're looking at, okay, there's an announced merger, because if you can't get ahead of that, that's illegal. Just FYI. That's why I kind of like theme ETFs for that equal weight, because if you equal weight a theme that's hot, like AI, sometimes the smaller companies are the ones that get bought. That's the only way to get ahead of true mergers and arbitrage. But okay, so it's announced, but there's always a small chance the deal falls through. And so there's this premium between the price now and the price it closes at. This is trying to capture that, correct?
Correct.
Okay, and that's why the volatility is low, because you short beta to do that. Okay, so it's a true alt. These true alts, Joel, it's really a great concept. Hedge funds love it. Institutions love it. They are a tougher sell with the general advisor. I just think either it's too complicated, doesn't move enough,
right,
hard to explain to the client. The client say it's only up 3%, but you're like, well, on a Sharpe ratio is high. He's like, I don't care.
Yeah.
I think that's the problem, because these alts that do it the real way have struggled to get going, even though an institution would like this, although an institution would go and get it directly from a hedge fund offline.
And that's what the concept that we're trying to deliver is like, if you're a $4 billion family office, like, we want you to like now think about merger arb as like a way to kind of get unique sources of risk and return, but do it as an SMA with a specialized manager.
All right, you have another one on here, which looks like it has a story in the name, which I don't mind a little self-plugging here. It looks like you have 2 on here that are your own. That's okay. We'll let it slide. I mean, if you're not going to eat your own cooking, who else should, right?
Well, the funny thing is, if you look at like, so last year's, because I don't like to repeat tickers, Joel. Like it was,
he's just showing his sell side roots.
So they won't be on next year's list because I don't like to repeat it. So yes, we do have some of our own ETFs. If you look at like the Barron's Roundtable Year Ahead report, some of the portfolio managers do have their own mutual funds in there. So, we like to eat our own cooking, let's say, and if it fits the theme and if it's not a repeat from last year, then we'll go ahead with it.
This is called the AXS Astoria Real Assets ETF. Now,
tickers PPI.
PPI, you got good tickers here. Joel, when I wrote the first book on ETF Toolbox, I interviewed institutions, and they love the real assets, which means the Yale model. This guy, David Swenson, wrote this book bragging about how great Yale did by not using public equities, but by buying like timber and like hedge funds and private equity and alts and real stuff like that you can touch and hold. And so these real assets you can't get in an ETF. However, you can get real assets that are like equitized, like REITs and stuff. So I guess that's my question to you. How much of this is really achievable in the ETF wrapper to get real assets, which is largely used as an inflation hedge or a way to incorporate the Yale model, versus doing it the way that an institution would, where they literally buy
timber?
Yeah.
So we definitely can't buy, physical timber, or, I think one time Yale bought like a bunch of, woods, timber and actual real woods. Our point here is that like these stocks are pretty cheap, like whether it's material stocks, energy stocks, industrials, REITs. I mean, there's utility stocks that, kind of play into the theme. So if you look at PPI, it's actually like, 13P ratio. And, this fits our whole like, Trump's pro-growth, pro-policy, tariffs, protectionism, leading to higher inflation. So, and this is more in like the, 4 or 5% allocation, just to kind of offset the risk on the other side of the portfolio. And, the funny thing is, like, when we launched PPI, people were like, oh, it's thematic. It's, and since we launched it, PPI has beaten the S&P by 300 basis points, and it's coming up on a 3-year anniversary. And if you told me back then that we beat the S&P, so it kind of shows me that, there is some, like, intrinsic value in these stocks, these, energy, industrial, material stocks. And then it is value. And I do think that value works, like, to this concept of, like, is value invested dead? So our point is, like, use that to kind of in your alts bucket.
How much timber do you own in that?
No timber.
No timber.
There are. Didn't you pick the timber ETF as your favorite ticker one year in one of our games?
It was for the purposes of the episode.
And cut.
Yeah, wood. Cut. I think it was the one that outperformed wood, right?
Yeah.
Like,
wood and cut. They're like the timber twins.
Yeah, I remember those.
They've been around for a long time. Hey, let's play a little ETF game. How much assets do you think wood has? It's the iShares Global Timber and Forestry ETF. Let's see. Let's test your ETF skills. This is serious nerd level question here.
I would say 300 million.
Pretty close. 175.
175.
You were within
what
reason.
About cut?
Well, guess cut. This is
Cut is from Guggenheim?
Invesco.
Okay.
Formerly Guggenheim.
Yeah.
That bonus points for
I'm
that.
going to say
over under. You can do the over under too.
I would say lower than BlackRock's, because it's BlackRock versus Invesco. I would say probably under 100 million. 85.
55.
Okay.
Pretty good. Yeah.
Performance?
Performance between the two. Let's see. Cut is up. Yeah, I'm curious how, like, we're going to go since inception?
Yeah.
Okay. These things came out a long time ago. 2016 and wood. So this is about 10 years. And we've got, wood seriously beating it with 112% versus 87% for cut. But, like, the market was up quite a bit more during that time frame, 246. So honestly, this is not a bad, if you like your value, I get why you like this. This beat up, has a chance to run.
But there's no wood in the portfolio.
I know. Well, you may want to rethink that.
This has been a great
saying.
Tangent. Just a branch off to the side. We'll bring it back to the Trump.
These are exit ramps.
Yeah.
But as I tell people when I'm doing presentation, get back on the highway quickly.
Back on the highway.
You don't want to end up in a lake. You know what I mean? Like trapped in your car.
Roll the window down ever so slightly. John, let's talk about commodities. You've got a broad basket, ticker CERY. That's the Spider Bloomberg Enhanced Roll Yield Commodity Strategy number K1 ETF. As names go, that's a mouthful. Why this particular one?
So, there's physical commodities that we think we should own to kind of play higher inflation. And then there's like, the real assets, which are like, commodity equities, let's say.
So similar to the PPI.
Yeah, similar to the theme. I think, it makes sense to kind of split your exposures. Something like commodities, I think you have to be active. I think in real assets, you have to be active. So CRVY is just going to try and optimize, the roll yield, pick different points on the curve and, trade these futures. So I think it makes a lot of sense. And, our point is like with these things, like, 2 to 5% of your portfolio in case inflation is going to be stickier and higher for longer. And that's what's proven to be the case.
Have you ever filled out a K1 form?
I've definitely gotten it. It's annoying.
Yeah. So isn't it weird, Joel?
What is the
they
K1
put
for?
no K1 in the title.
Yeah.
It'd be like a business going because it's not the end of the world, but it's someone in my book referred to it as like a paper cut. But I'm thinking it'd be like a convenience store like Wawa saying no paper straws, or like we only do plastic. And I there's some people who'd be like, yeah, I hate paper straws. Like, not the end of the world, but when in doubt, I'm going to pick the plastic straw store, all else equal. I think was that a fair comparison to the K1?
I think so, yeah. I mean, it comes so late in the tax season, it just kind of ruins you because, like, you thought you did your taxes, and all of a sudden in April, after the date, the April 15th date, you get this K1, and you gotta go back and redo it.
Yeah, people hate that form, man.
So here's some trivia. Who came up with the no K1?
No K1. That was going to be...
I'm going to say Will Ryan.
Yeah,
from
I think
Granite
Will Ryan
Shares.
probably started with it in the label.
In the label, yeah.
And then everybody copied him. Usually an indie is the one who spearheads something like that.
Yeah.
But I do remember back in the day, I think there was a couple that didn't have a K1. First Trust, I think, had that Cayman thing where you register in the Cayman to get around the K1
right.
with FTCG. And I think that was the first one to do it, but I don't think they said no K1.
I think you're right.
But I think an indie put no K1 in the actual name. People were like, well, screw it. I guess we should do that too, just to let people know what they're buying and not buying.
So what does it achieve here?
The no K1? Just it doesn't have that additional tax filing that is required from other ETFs that have K1s, let's say. So.
Okay. Bring it home.
All right.
Last one,
but not least. Quality growth, Joel. I mean, as far as equities goes, this is about as boring as it gets. Well, maybe not. So Athan on my team, Athanasios, and Todd Rosenbluth, these guys love the GARP. Growth at a reasonable price. This seems like GARP-ish. Astoria U.S. Quality Growth Kings. So it's like, we want the growth, but Joel, we don't want to get too crazy. We want the responsible growth companies. And I get it. It's sort of like the Goldilocks way to do growth. Am I right?
In essence, yeah.
Okay.
And we are capping the weights on the upside, but some of the other GARP ETFs, I would say, have like a 2%, 3% allocation to like whatever growth, stocks they have. We'll go up to like 5-6%. So we do own some of these Mag 7 stocks. Like that's the thing that we're saying in our story is like, don't fade Mag 7 because they are such a big part of the stock market, but cap your upside, let's say.
So this ticker is GQQQQ. Are you saying that you start with the Qs in this and then you sort of trim it from there? Is it like the NASDAQ 100 your base index before
we start with a broad universe of growth stocks for sure.
It looks Q-ish. I mean, NVIDIA, Apple, Microsoft are the top three holdings, but their weightings are a little smaller than the regular Qs. But like Oracle's definitely got a higher weighting than it does in the Qs. And Broadcom, it's pretty close though. Yeah, I get it. It's like diet Qs.
Yeah, I think you've said that before, like tempered Qs. So we are trying to kind of combine, growth investing with quality investing. One thing I'll say about the NASDAQ, ETF is that there's like no inclusion criteria outside of you just being listed on the NASDAQ and being, the top 100 company and non-financials. Like that to me is like maybe this is why it's so successful because there's like literally no one thinking about like the portfolio construction. At least in the S&P, you have to have 4 quarters of net positive earnings. So like, you've got to have some type of heartbeat as a company to be included in the S&P.
The Qs is unbridled.
Yeah.
Unbridled American capitalism.
Until you put the G in front of it, and then it tempers it a little bit.
I know. It's like, all right, let's sober up, everybody. This is getting too crazy.
Gut check. That's what the G stands for.
There you go. No, it's good. It makes sense, man. All this is very logical.
But if you have to like say, okay, like what's going to be part of your portfolio that you can kind of comfortably kind of reside on, what we find is that like value's tough, equal weight, we have to like, thread that needle with advisors, but like no one's going to push back on growth or quality stocks.
So of the 10 ETFs here, and by 10 I mean 14, 3 of which are your own, how are people supposed to put together a portfolio of this? Is the idea that they're only going to cook with this, or do you want them to add this in little doses throughout the portfolio?
I think so we're talking about like the chef episode of Trillions. I think small caps should be part of the main ingredients. I think things like ARB, things like CERY, PPI should be like the side dish. Kind of like the hot sauce type ish. ROE, I think, could be in the main. GQQQ could be in the main. I think Ethereum has to be, on the hot sauce bucket. But it is a microcosm of how we want people to think about investing, which is like combining different asset classes, different factors in a portfolio. It's not meant to be like, the only way you put all your money into the investment account.
All right. We'll be keeping an eye on this in 2025, John Davi. You've got some interesting ideas here. John Davi, thanks for joining us on this episode of Trillions.
Thank you.
Thanks for listening to Trillions. Until next time, you can find us on the Bloomberg Terminal, Bloomberg.com, Apple Podcasts, Spotify, or wherever else you like to listen. We'd love to hear from you. We're on Twitter. I'm at Joel Weber Show. He's at Eric Balchunas. This episode of Trillions was produced by Magnus Hendrickson. Bye.